This whole tariff and economic volatility aspect and living day to day based on tweets and everything else, effectively, that the rest of the world is now basically living in the startup bubble.
When you're looking at a founder, you totally look for and say these are great green flags, but equally, what are the red flags?
There are certain qualities that you look for. I think this is a 10-year plus relationship with your founders. You need to know what they're like as people. And I think one of the things that also will draw out is their qualities. It will probably give you a sense of their ambition, their drive, their resilience.
I don't think we lack the cash in this part of the world. I think we do lack the experience and some of the grit and resilience. We'd love to see that, more of it. One of the countries which doesn't get talked about much. And these guys are solving real problems at scale, mostly using infrastructure. So, ladies and gentlemen, welcome to today's episode of Couchonomics with Arjun. This one is yet another virtual one. I think we're getting used to these virtual episodes, but the good bit is we tend to get hold of some great guys and girls from across the world. Joining me today is Devin Kohli. Devin is a general partner and co-founder of a VC firm called Outward VC. If I'm not wrong, I think they're headquartered in London. But with that, let me welcome Devin to the show. Devin, thanks for making it.
Thank you very much, Arjun. Pleasure to be here. I think we were kindly introduced by our very socially networked friend, Amir Nuralia, who I think has been a friend for both of us for over a decade.
Yeah, I've known him. Well, that just tell you how old him and I are. We've known each other nearly 2 decades. But you can use that word socially networked very well. I think, I don't know, if, how does he cope up with that social circle with all those kids? I struggle with 2, but hats off to him. So shout out to, I guess, Amir for making this happen. Devin, indeed. I'm going to dive straight in, right? And I guess this is the first venture capitalist private equity player we have on season 4. So I'm going to start with this very simple question, state of the nation, right? 2023 was terrible compared to 2022. 2024, at least from the numbers that I see, were down against 2023. You might have a different set of numbers, but those I am, right? So I guess 3 parts to this question. One is give us paint a picture of the, the state of the nation from your sort of perspective. Second question is, how is it actually changing some of the investment strategies from, VCs like you, but, you can talk about the industry if that's what you prefer. And then a little bit of how's this founder expectations evolved, if they have at all, right, with the backdrop that we've seen for a few years, because I guess now they've all woken up to the reality and smelt the coffee that, money's not going to come that easy and not that cheap. So keen to hear your views.
Yeah, I mean, the state of the nation is a very topical question at the moment. I think we need to go back even further, because I feel in order to understand the state of the nation today, you need to also look at the over exuberance during COVID. So COVID allowed for the lowest interest rate environment we've had in decades. You've had an oversupply of money, and you had inflated valuations, and people felt for 2 years that was the norm. And then it comes to a grinding halt, and Putin's invasion is one aspect of that, but the rising interest rates was another, and the whole effectively stack of cards came tumbling down a little bit. And I think that was healthy, and I think that it's right that the market corrected in the way it did. And so middle of 22, all of 23 saw a massive recorrection, recapitalizations. Some companies obviously hit the wayside, a few scandals, and I think 2024 was an era of rebuild. And I'm talking globally here before we sort of dig down into subsectors and geographies. And I think 2025 has started a little bit more, I think, with a little bit more optimism. And I think the optimism is rooted in realism of actual profitability metrics, other metrics which are important for venture capital to assess. And I think it started in my view anyway on a positive note. I look at it specifically through the lens of FinTech, which is outwards focus. So just to give you a little bit of color on Outward, we're an early stage focused FinTech fund, sort of looking to be the principal check as the company really scales up. So we tend to lead those early rounds, 1 to 5 million, and then back our companies as they grow. And so if you look at just from the number of deals to the amount of money going in, particularly in our sector, it is a significant increase from last year, which in itself was an increase from the previous year. That said, that's not uniform across all VC. If you take fintech and biotech, I think they're probably up there. If you took e-commerce and other areas, they're probably a little bit down. So I think it's horses for courses in terms of sector, in terms of the state of the nation. I think geopolitically, it is even more so. I think there are pockets of significant growth. The Middle East is definitely an area, and I'm sure we'll come and talk about that. I think Europe is seeing a bit of a renaissance, which is good. I think the US is in a state of flux, and that's driving a lot of the world, and obviously where we end up with China as well. So I think also geopolitically it is fragmented. And whereas you used to see VC as a holistic market, you don't anymore, and you shouldn't.
That begs two questions. So I'm going to take you back a little bit in time, right? So first question is, I think you used the word exuberance, and I think that is the right word. I think it was a little bit self-created. I think, VCs had a sort of, I guess, a not so good role to play in that sort of exuberance, which is around growth at any cost and so on and so forth. So two questions. One is the collateral damage or the damage which was experienced with the correction, I personally feel was more overweight towards the startup community versus the VC community. I think the VC community arguably came out of it less impacted, not saying it isn't impacted, than I think the startup community. And I think a lot of good ideas didn't get funded because there was this sort of broad brush approach towards, where, the shutters are down. That's first question. And the second one, well, let's start with that one because I think the second one is unrelated to that, but it's something to do about what's happening currently. Your views, do you agree with that sort of perspective that I have, or is that very much my sort of very narrow, very specific view in the world I see?
I would look at it a slightly different way. I would say there is an over exuberance of money. There was also an oversupply of founders. What I mean by that is it became quite fashionable and quite on it to set up my own startup, right? Money was cheap. I can do this, etc. Were you actually trying to solve a clear problem? Were you actually prepared for the hustle that it entails? And so you had a wave of money, new funds and existing funds, and a wave of founders. And this created an oversupply on both sides of the marketplace. What you saw quite quickly was in the correction was companies dying first. Obviously, there are limited runways. There's not enough growth to support a recap or a refinance, even at a lower valuation. So they'll die. And then what you also saw was, and now the time lag, and with VCs, the time lag takes longer. And that's where I guess I differ to what your assessment was, is that VCs are obviously running on a 3-5 year investment period. If they're unable to raise that second, third, fourth, fifth fund, they will fall away. And you're seeing that now with a few names of people just pulling out of VC totally. And what you also saw was tourism in the space. So not only did you have people setting up first-time funds, or people during that sort of COVID boom, but you also had people who'd never been VCs before through family offices or high net worth individuals going, oh, I'm just going to put a wall of money in, and they got burned. They came in high valuations and they got burned. And so this pullback of capital, both people unable to raise their second fund or third fund, etc., and or people who had historically never ventured into VC and got their feet wet and got burnt, pull out. So I think there's a time lag on your question. So immediately the impact was the overexuberance was felt immediately with companies, but I think now as the dust has started, correct.
Okay, so fair enough, and I think that makes perfect sense because, as you said, the cycles are different for a company versus a VC. Second question to what you had initially talked about, and we come to now. It's been called tariff wars, trade wars, call them whatever you want to call them, but we are in a very sort of sort of bizarre environment. I have no better words to use it. Are you starting to see that play into the VC world or the investment world? We've obviously seen some IPOs being pushed back. I'm assuming that's largely because there's a certain degree of volatility in some of the markets, and so therefore the IPOs are sort of saying, we can stay away from the public markets. Let's stay away. Um, from a VC perspective, how much are you starting to see the impact, and how concerned are you about this sort of state carrying on for longer than it has, or is it expected
Mm.
to?
I think my first observation there is that this whole tariff and economic volatility aspect and living day to day based on tweets and everything else is is effectively the rest of the world living in a state of startup frenzy, right? It is, and this was actually, I was having a conversation with Yusuf from QED, and we were, and this sort of was something which we were just, we felt that the rest of the world is now basically living in the startup bubble, like what's happening from day to day, and I don't know if I'm up, I'm down, and I think in a way that builds, if you take the optimistic view, that builds resilience, and we in the VC slash startup world have become very anti-fragile, or we, the best of us are, and I think now the rest of the world is having to be anti-fragile as well. They're not used to it and they're adapting. Um, what does that mean specifically for VCs? I mean, look, for the United States, the potential risk here is a flight of capital away from the US, and as a consequence, a flight of talent as well. Um, you know, as much, and we may come on and talk about some of the negatives of Europe, but the UK particularly has an opportunity here when it comes to attracting that flight of capital and flight of talent. If it plays its cards in the right way, that's up to this government to do that. We have our own views on it, but I do think that the danger from the US is that this becomes, this volatility turns into a flight. And I think also that also impacts, how the public markets are reacting. Now, if the public markets have rebounded a bit in the last few days, but if IPOs continue to get pulled, Klarna is one that recently had to pull, then you are seeing a build up of exit or lack of exit liquidity, which in turn will have a knock-on impact onto the whole VC landscape, including VC funding. Because for every IPO, there is a release of money going back to early stage investors, which goes back into the founding community. So if you stop that, you have a problem.
Yeah, and that's
The only way you
it's
can compensate is maybe M&A.
yeah.
And
No, I was going to say that's very consistent to the conversation I was having with a few people, I guess earlier this week, where we were talking about what does it actually mean for the VC community, for the people who are actually putting the money into the VC community, and are they actually just going to hold back? And I guess this uncertainty is only going to get calmed down once China and the US sort of figure out a way that they're going to coexist in this world and let commerce flow. Let's take. I'm sorry, I've taken longer than I wanted to in this opening question. I wanted to hear a little bit more about outward VC. I guess the audience would like to know a little bit about. So talk to a little bit about the genesis. How did you guys come about? What were sort of the driving principles in terms of which have driven your investment philosophy, and paint a picture around what are clear red flags, what gets you really excited about cutting a check.
yeah, sure. So I think Outward launched in 2019, but the concept started in 2016-17. And myself and my business partner, Kevin, both of us had a history of investing in early stage companies. And both of us had met at an investment bank in the UK where we started our career. And the two of us had gone on different paths prior to then. I stayed with that investment bank, investing and advising fast growing tech companies around the world. And he set up his own fund just at the time where FinTech and London became synonymous with hypergrowth. The launch of TransferWise, Silicon Roundabout. This is 2011-12. And he had by 2016 we kept in touch, and he had a problem with there was no money to follow on some of these companies, and there was a group. Increasingly we saw London becoming a premier global fintech hub, and for us the sort of penny dropped when we were like, there is plenty of money at the angel world, particularly in Europe and particularly in the UK, because of the tax system that they created to incentivize angel capital. And there's plenty of growth capital, where I mean like people writing 20 plus million, culminating obviously in SoftBank setting up its Vision Fund headquarters in London. But that gap in the middle, that I want to raise more than 1 million, but I want to raise less than 5 or 10, was really underserved, particularly for fintech founders looking to go global. So we said, okay, that is a huge opportunity for us, and we sort of created a thesis around being the go-to fintech fund for founders in the UK and Europe, and that is what we pitched our tent on. And through good fortune and hard work, we were able to raise our first fund of 50 million, which launched in 2018-19, and then that's performed pretty well. We've picked some good category winners in that, and then on the back of that, we launched our second fund in a very different fundraising market in 2024, which was backed by principally the same people who backed Fund 1, but also the British government, who came in as our anchor investor in Fund 2, which is a great validation for us and what we stand for. And our aim has always been to back companies in what we define as fintech in the connected sectors. Maybe if I just for a second elaborate on that, what most people think as fintech is payments, capital markets, etc. Yes, that's core fintech for everyone, but I think for us, the adjacent sectors which are being disrupted by the innovation in financial services, whether that's energy, healthcare, education, are also areas that we look at. And if you see some of our investments in Fund 1, which on the surface look like a healthcare company or an education company, root back into financial services quite well, and actually have been some of our biggest success stories. So we define fintech pretty broadly, and that's always been our thesis from the beginning. And the same team and the same thesis has driven us into Fund 2.
How much have you deployed to date? How many startups do you have on your portfolio?
So as of now, we have 25 companies across our 2 funds. The first fund was 20 companies, and we've deployed now 5 deals out of Fund 2, which launched last year. We are looking to take that second fund from 5, which it is right now, over to about 20-25 companies in Fund 2 over the investment period, which is probably the next 3 to 4 years.
Okay, so by 2030, 50 plus companies in your portfolio, if not more.
Yeah. And we should be hopefully on a third fund not by then.
I'm sure, because we've got more than 3 years to make it. I think we're 2025, but I keep forgetting. So lots of questions here, right? This is my view again. How much of VC is science versus art? Okay, I'll very, very keen to hear your view. I'm one of those guys who sort of sat on the, if I may say, the outside of the VC world. I'm sometimes very critical. All my VC friends will tell you that, right? As a matter of fact, some of them have come on the show in the past and said that, you come back and all you want to do is challenge us on things we don't know, which is not fair. But not that I know any better. So to be honest with you, I do say that with entire humility. Keen to hear, and I love this fact that, you guys, if I may use this term, you're sort of embracing embedded finance as sort of the ideologue for, what fintech is all about, which is actually quite interesting. And, being a consultant in my career, that's kind of where we are also finding our sweet spot in terms of where we're advising a lot of our clients, right? It's the telcos, it's the healthcare players, it's the automotive players, the aviation players who are actually using financial services either to augment their existing business or find another line of income, whether it's an adjacency or more to the core. So a couple of questions. If you don't mind, I'm very keen to hear about a couple of notable investments which have sort of,
Mm,
which have delivered to the ideology or to the philosophy of the fund entirely, right?
mm.
And if there are a couple out of the 25 or 30 that you've invested in who've kind of given you a bit of a surprise, right? And they've grown, or they're they've hyper grown, and but sort of in a way that you guys never expected it to. So keen to hear that view, because I don't think many VCs talk about that, right? We all talk about
Mm.
hundreds of investments we make, but I think it'd be good to get a couple of stories out there. And you're
Yeah,
happy to plug their names in or not. That's totally up to you.
yeah. I mean, I think the first thing to say, which is very interesting, what you said about being cynical. I think the job of a VC is to be half cynic, half dreamer, right? And I think it's about getting that balance. If you're overly optimistic on every company you meet, then you'll be backing every single company that you meet because everyone's got a great story to tell, right? At the same time, if you're a cynic all the time, you'll have challenged, you won't invest in anything. So I think you have to form a view. And I think what we are constantly learning as a fund, and we're as a team. And I think for us, we took the learnings from Fund One, what worked, what didn't work, and try and apply it also not just to our investment approach, but also to our diligence approach. And the things that you sort of see, the pattern recognition, things that you see about founders, about teams, about um, deal structures, which help you sort of form a view. I, I mean, I am constantly amazed about, you know, behind the scenes on a startup is very different to what LinkedIn may imply, right? And people have a very rosy view of the startup world. Oh, look, you're a startup founder. It's great. I I am in WhatsApp groups with all of the companies I look after. I look after about 5 or 6 companies, which I'm responsible for with one or two of my colleagues. It's probably not a week that goes by where something has not gone wrong with one of our companies, and those are material situations. And just to give you like context and color, and I'll mention a couple of our companies along the way. I mean, so let me take a company called Curve. Right, it is a business which is probably one of the oldest in our portfolio. We invested in the business in 2017-18 as we're getting the fund set up. It is effectively an operating system for your money where you can spend, send, see, and save from one platform. Connects all your bank accounts, all your loyalty cards, everything. The journey that founder has been on has not been linear at all. It has been up, down, near die, 3 or 4 times. They've raised quite a lot of money, and that there are many lessons that, for example, we have drawn from that. And one of the things that we are perhaps most proud of is that despite being not the largest shareholder in terms of money in or percentage, we're probably the first phone call, because the relationship with the founder for us is pivotal, because we're one of the earliest investors in the company, take a board seat, really wrap our arms around these companies. So when the proverbial shit hits the fan, I'd like to think we are the first phone call, and we have been. And in this instance, you know, there have been a number of phone calls late at night, including one saying that the business will be shut down the next day because Wirecard has just gone bust, and all payments go through Wirecard. And the company was in the middle of a Series C fundraise of 100 million at the time, and the company couldn't even function the next day. And that type of stuff does not make the news. Doesn't it's not one of the glossy things you see on LinkedIn, but it's how you solve that problem and the resilience around the founding team and processing things, and how we as his network and partners can help him in this instance. Those are the things which actually give me like a lot of satisfaction in my job, but also illustrate all the things that can go wrong behind the scenes. Now, that was a macro event, which was like a bit like a out of the blue thing that he couldn't control. We had another company, I don't think it's right to mention the name, but the founders, the business was going very well. It had gone from 2 grand of revenue when we first invested in it to sort of 10 million of revenue in 2.5 years. But the founders, 3 of them, didn't get on. And there was a bit of an issue there. And working through that problem with them. And so, in that instance, we brought in a sort of psychologist and doctorate who helps us on those things. And they were able to sort of work through the problem. That's something you never hear around again and they were really at each other's really causing a material problem to the running of the business. You had another situation where, and I can list millions off the top of my head, where the company had overhired by 30 people. The separate company had overhired by 30 people. I mean, how you practically do that, I'm not sure. And then separately, how they had misreported regulatory capital because they were a regulated business. And these things are things again that only a board sees and only your sort of lead investors see. And these are things which are going on all around as a business grows, and it's how you deal with them, right? Because you can throw your arms up in the air, and so these are sort of events which I see with some of our companies, some of which are forced, some of which are not their fault, but you have to work through them. On the other side of the spectrum, you see, and maybe just the other side of your question was around like really like things you've been really happy to see. I mean, we had a very material exit quite early on in our first fund. It was a business called Vauban, which was sold to Carter in the US. Inside 12 months or 14 months of us investing, at a material markup to our investment. This was 2 French founders, British business, basically automating the whole SPV creation process. Instead of you, Arjun, calling up your lawyer who calls your accountant who calls some administrator, and you guys, because you want to create an SPV for you and your friends to buy a property in Monaco, for example, or they can do this very, very seamlessly with a bank account. Great business. They had also were setting up at the time sort of real estate investment platforms as well. And they had to pivot to really focus on VC, move away from sort of other alternative asset platforms. But they did it really quickly and they did it really seamlessly. And, that's a great story of pivot. Yet, the underlying problem they were still solving, but they had to switch lanes. That was, to me, like a really smart, really good, founders who really had a grip of what their market and were able to move very quickly at the time where VC was becoming very popular in the middle of COVID, and people doing investments on the side. I think another story, if I may, just on pivots, is like, I know and I've been an investor for many years, no one who, or they present their business plan for the year, 3 years, 5 years, and like it presents as a great story, right? But it's never straight line. And how well you pivot when things aren't going right is also, to me, a mark of a successful or smart founder. And another case in point is another our portfolio, perhaps, Ed and George, who are the founders of Bud, which is an AI open banking platform, which is driving sort of transactional data to some of its large clients. They started as a direct-to-consumer business before we even invested. I think they quite quickly realized that was not going to sustain itself. And so when we came in, they were at the birth of open banking in 2017-18. They were sort of at the vanguard of it, and they picked up 1 or 2 large clients, including HSBC. But during COVID, I think they will themselves testify, really struggled. So what was it that changed the game for them and moved them from a couple of million revenue to 15 million of revenue in the space of a couple? Was actually one of the founders getting on a plane and going to the US and living there and opening up that market. And that was a pivot geographically, but it was also a pivot very early on at the beginning of the AI revolution to really build out their own AI native products. And I think that worked very well for them. So I think being nimble in your thinking has also, and that's to me like another success story of our founders being able to think quite coherently and on the fly.
So if we bring this together, right? So, I think I've heard you say you rather invest in teams rather than products, right?
Mm.
I think you've talked about it. You brought that sort of statement to life. Simple terms, when you're looking at a founder or an early stage founder or founders, are there 3 or 4 things you always look at when you're going through your sort of assessment of their pitch deck or the team? Are there sort of
Mm.
are there things which you totally look for and say these are great green flags, but equally, what are the red flags?
I think there are certain qualities that you look for. Um, and what we've refined our investment process actually and our diligence process pre-investment to spend a lot more time with the founders, getting to know them as people, because I think this is a 10-year plus relationship with your founders. You need to know what they're like as people, and I think one of the things that also will draw out is their qualities. It will probably give you a sense of their ambition, their drive, their resilience when times have gone bad. And if you look at our best founders in terms of performance, I think there is a direct correlation between some form of personal discomfort and life journey that they've been on. One and again, to give you some context around this, like one of our founders who I'm being most supportive of, lost both parents and separated from their partner within 1 year. That's a brutal thing to happen, and yet that was also concurrently the biggest growth spurt in the time of the company, because they channeled everything, all that hurt, all that, into that business. And that takes this type of special person. And I think that those qualities, there's no sort of magic wand or sort of barometer you can measure these things by, but in enough of getting to know those people and that team and those founding set, you draw a view on their qualities of ambition, drive, resilience, also humbleness, what they don't know. And I think what we've also seen is, people, the best founders are those who put their hand up and say, look, I don't know enough about that area. I'm going to bring someone in, rather than trying to claim they know everything. So I think those are sort of the higher qualities we look for. Of course, there are certain specific things, like domain expertise in a particular area, great network, having sold into the same vertical that they've done, that they're trying to build their new business in, and the relationships they have there. Have they done it before in terms of being a founder before? So if they've been through this journey before, it also helps. The relationship with their co-founders, very important. Like, how did they know them? How long have they known them? When have they had their first fight? Talk me through that. How did they resolve it? These things are also very significant. And then there are more quantitative things, like how much money they put in the business themselves, how much are they paying themselves. I don't want them on the poverty line. A lot of VCs say, oh, they've got to be paid under a certain. Oh, I don't want them on the poverty line. At the same time, I don't want them paying themselves, to collectively, half what the money that's coming into the company is going straight to their. You've got to look at all of that, and incentive structures.
Mm-hmm.
Those are all more quantitative aspects that we look for.
Great. We're going to switch. Let's start looking at the future. I do want to talk a little bit about Europe, you mentioned, but before we get into it, so you're obviously looking at, as you said, adjacencies to the fintech, the financial services sector, which are being disrupted by finance or augmented by finance, whatever the right word here is. But from where you sit today, and you've got 20, 25 more companies to deploy in your fund too. Any sort of brand new, hot emerging sectors? Please don't say just AI, right? That you're looking at, and are there certain sectors that you guys have consciously sort of made a decision to sort of move out of? I was with one of your peers, no names to be taken here. I met him in Japan. We had a fairly frank chat, and he said, "Arjun, I'm looking at B2B infrastructure. right? Fintech infrastructure, because to me, that's kind of where true disruption actually happens. Because a lot of the B2C players I see are just sort of me too's, right? And with a variation. Not I'm not putting words in your mouth. I just want to hear your views. Hot emerging sectors you guys are super excited about, and sectors that you feel that you're kind of sort of moving away from. And then, if I may add, the third one is how are you avoiding the herd mentality, which is with everything to do with AI today, right? And maybe you're not. So
Yeah. Um, I think areas that we're spending a disproportionate amount of time on: asset management, wealth tech. Why? Because those are areas which haven't yet been significantly disrupted in FinTech 1.0. These are also the higher margin areas of financial services. If you look at the sort of revolution of tech in financial services, it started with low margin remittance, neo banking, current accounts on the consumer side, um, uh, sort of nice platforms for B2B. It's now going in a step later, and AI has helped go into those areas. Um, and I think so. I think wealth tech, definitely, asset management. I think verticalized AI when it comes to certain areas, for example, fraud within sort of insurance, very interesting area for us. Um, uh, Diligence within that AI can do, which is and sort of automating areas which have hitherto been done quite manual. Example, diligence on the conveyancing of property, diligencing of for private equity when it comes to buying and selling assets. We've made investments in both of those areas. Um, that's an interesting area. In terms of, I think there's a wider aspect around energy and energy distribution, how that's financed. Um, as the world moves towards more renewables, we are building renewables in areas that have historically never had renewables. How is that being financed? And then there, as a consequence, there are risk models being built around that. That's very interesting for us to look at from an investment perspective. So those are sort of areas which we as a collective are looking at. In terms of areas we're moving away from, I think we've always had a reticence towards companies which need to raise huge amounts of money. And so that, leans itself towards more consumer facing areas, but also areas where there is significantly low margin. And so therefore, you know, savings apps and things like that, we've tended to move away from. We've never really made a play, and as a consequence, we're very, very skeptical of those areas actually building out to become sustainable big businesses in their own area. They're dime a dozen at the moment. Also, areas of climate tech and ECG, if they're merely dashboards or things that don't really actually show proper technology. I think those days are numbered there.
and those are in abundance.
Indeed. I mean, yeah, I would be a very wealthy man for the number of deals we saw or companies we saw trying to raise as another ESG tick box platform. So those areas we're not really focused on.
What about digital assets and the whole sort of crypto world? Have you guys stayed away from it?
Yeah. No, we've made one investment in the off-ramp, on-ramp space, the infrastructure side. And actually it's a Danish business called Januar, which is performing pretty well. I think for us, we are not digital asset specialists. We find that, we are sort of slave to pending regulation on that area. That said, we do feel there is a world where digital assets will become a portion, an accepted portion of someone's portfolio. As a consequence, banks and need to show that they can hold, vault, and have the infrastructure to effectively manage crypto. And therefore, that is why the logic for why we invested in the type of infrastructure that we did.
Yeah,
It is not
I get
core.
excited about the whole, digital assets is obviously a very, very wide term and mostly
Mm,
misused by people like me. But I get super excited about things around tokenization and the ecosystem which comes
mm,
around it because, like, it's a no-brainer as far as financial securities are concerned. We're already seeing
mm,
evidence. We've already had historical evidence, and then slowly and steadily we start looking at real-world assets. I don't buy into the $30 trillion number, but I don't buy into most of these trillion-dollar numbers. But then
mm.
that's the cynical part of me. But I do think that that's quite interesting, and it doesn't, in my humble opinion, yes, we need expertise, but it's not that far away from the realm of fintech 1.0 or 2.0, right? To me, it's just another way of powering. In any case, I'm not influencing your investment strategy here. It's a personal perspective. AI. So is that big on the agenda? Are you sort of building your team out? Because I think with AI, the whole thing is that it sort of, it has this ability to sort of break the entire value chain into these sort of micro segments because, you can really, really get atomized in terms
Mm.
of the AI use cases and how they can disrupt. And then, if you can achieve scale. How are you guys going to avoid throwing a lot of money out there and, I don't know, the 1 in 10 success rate or the 1 in 20 success rate becomes a 1 in 200 success rate? Because,
Yeah, no. So it's a great question. We're not expanding our team to focus on AI.
right,
I think AI permeates all technology,
it does.
including fintech. And I think the question is, if you're an investor, how do you play the game in terms of where realizing value? And for us, we took the view that AI is going to become ever abundant, and as a consequence, there's no point trying to reinvent model LLMs or anything like that. The question is, where is the verticalization going to create the most value? And so if you look at areas where the big players, it's not core for them. What I mean by that is, let's take the private equity diligence space, right? And automation space. That is quite a niche area, but a very valuable area. If someone can build a tool with a specified product for private equity to do their diligence in a far more efficient manner, that creates value. If someone can build a tool for someone to buy and sell a house with lawyers built in to automate that whole process in a far more seeming efficient manner, that's also going to create value. Now, then it's about distribution. So in both of those instances, and I mentioned it earlier, we've invested in one in private equity world called Capsa, which has already got paying private equity clients using the tool because it's built for private equity professionals by private equity professionals. So they came from the industry. Same with Orbital on the AI side for property. They're working and using what is already there on AI and layering on top to provide a service for all lawyers and even property owners to help assess risk and buying and selling of their property portfolio, commercial and resi. So I think in both those are quite deliberately clear, but also I won't like very specified use cases. And so therefore I think the play in our view is verticalize very specific use cases for AI where you can own the market quite quickly and become the go-to player. That is our thinking.
Yeah, and
And
fair
that
enough.
is how we've deployed.
And I think it's a sensible approach to go, and I think it's one which is, you take a stance, the thing evolves, you evolve, and then this is the thing around AI that I think we'll just all have to be incredibly reactive, right? There are sectors that I don't think we should be pursuing at all, either as founders or as VCs, because those sectors are going to be chewed up. I don't think the world is going to need 600 LLM tools, so on and so forth. So we'll see some concentration or some consolidation happen as due course, so people will fall by the wayside. Let's talk a little bit about Europe and UK because that's quite that's an interesting topic, right? People have, there's one part of the equation which says Europe is in terminal decline, right? At the same time, as far as VC investments concerned, unicorn startups are concerned, you guys have done fairly well, right? Both in the UK, Europe, and in the UK. UK has obviously had a change in government. right, recently, which I'm sure comes with its own flavor of changes and differences. I'm a Brit. I don't live there, so I'm a bit disconnected with what happens. Um, Paint a picture. You mentioned Europe's renaissance. What sort of renaissance are you seeing, and how important is the government role? And if I can just wrap one sub question in it, how does it feel like having a government entity backing your fund? Does that sort of impact your investment philosophy at all? Does it not allow you to do things, et cetera, et cetera? So I know lots loaded in that question. Let's start at Europe. Let's talk a little bit about the UK, and then specifically, the British government involvement in your fund too.
Yeah, sure. So I think Europe, from a tech and founder perspective, is at a renaissance. There is money going into the system, both government, non-government. US VCs have parked their buses now firmly on the lawn, ready to invest quite substantially, and they already have in Europe, because they're seeing the quality of companies emerging. What is holding Europe back are structural issues. One, tax. I mean, you can't avoid the subject, particularly pertinent in the UK. There's probably a reason why you're sitting in Dubai. I don't know, but it's an example. Why
I can tell you tax was not one of the reasons what got me
no,
here
okay.
15 years ago, but it's the reason which has kept me here. Let's put it that way.
So I think tax is something. I think how we deal with immigration in the right way is a second. And I think how we encourage entrepreneurship is the third. And those things, I think Europe is lacking. And it's also got a demographic issue to solve for in terms of deficits and how that's going to be funded. So Europe, I think, therefore, is at a crossroads and needs to decide which way it goes, because there is a path to success. It requires a bit of reform and some tough decisions, or there is sort of a sort of gradual decline, and I think more than Europe, the UK is probably, if you zero down on the UK, at that crossroads right now. We have had a situation where, we are still at this moment just take my sector, global FinTech hub. My question to government, it's UK FinTech Week next week. I've got meetings with various members of the government next week, is why would the next Singaporean, Israeli, Indian, Emirati founder want to set up their business in the UK, just as they did 10 years ago? We had a phenomenal talent 10 years ago from people all around the world. The UK was the place to set up a company. The rest of the world is caught up, and we are, instead of removing hurdles, putting more hurdles, whether that is on entrepreneurs relief and reducing it, whether that is on capital gains tax, whether that is on, cost to business to run and compliance costs. So we're doing everything we can to hinder our premier position in, say, our sector, let alone every other sector. And so my challenge to people is, it's all right now that founders are here. What about in 5 years' time? Are we still going to see that international founder come to the UK? But the UK has another path, and that path is to differentiate itself from Europe and attract that US flight we were talking about earlier. If it can pull that off, and that requires a bit of a rowback of reform from some of the stuff we've seen in the last year, then we have a chance.
And I think you raise a very good point. And it's not just about, getting UK to bear where it was about 10 years ago, if I may say so, because, I've been sort of involved in the wider sort of startup space for the last 15, 20 years. But now you have the emergence of a number of global hubs coming up, right? Like I'll give you an example. I've been going to Japan for the last 3 years, right? Japan's woken up. Let's be honest, it's the third largest economy in the world, right? They have a lot of in-country consumption. It's not necessarily, Southeast Asia. Now we have a number of centers, not just Singapore, right, which are sort of trying to position itself. India has become attractive to Indians, right?
Very attractive.
Yeah, right. We have the Middle East, which has its own flavor. It's being able to attract a lot of Indian startups. Actually, we see a lot of Brit founders come here, right, and set up shop. And so on, and the story goes so on and so forth, right? So actually, this is now becoming, if I may use the word, it's doggy dog, right? And it's at a global level. So I do think the UK does need to think not just from a Europe perspective. I do think in the short term they can sort of set themselves as, capture that flight of capital out of the US. Also, possibly there's some sort of flight of capital out of Europe, because let's be honest, the UK is always
that doesn't make up, but that doesn't make up for the number of people moving to Dubai or Monaco or Milan or wherever else. So this needs to be,
and it needs to kind of be amped up. And to be honest, I looked at the agenda of the UK FinTech Week and, felt a bit pedestrian, to be honest with you. I was expecting a little bit more boldness. I'm not going to be there in person. I've attended, I think, 1-2 years ago. It didn't blow my mind. I do think the UK really needs to sort of set up shop, or reset up their shop with a slightly different perspective. And I think that might require change in personnel and change of people, right? I think, there's this era of people, which I do think, and again, I'm not singling people out here, who need to kind of move on and let the sort of the new generation sort of take over with the new way of thinking. I don't want to hold you back from cutting the next check, which I'm sure you want to do before you end the week. So here's my last question. It's a two-part question. You've answered a lot of it, but I guess the loaded question here is, how do you guys, what's sort of the next 5 years? And I guess you said, deploy 20 more companies, raise another fund, right? You've obviously talked a lot about your sector, but talk a little bit about geographical diversification in terms of the startups that you're looking for. And obviously I have to ask you the loaded question here. Is the Middle East, in its broader sense, right, on your horizons? Not just in terms of attracting founders to come to the UK, but for you to bring the fund across here, because we've actually seen quite a lot of your peer group, maybe some of the bigger ones, if I may use that term, in terms of, who've been historically known to have set up multiple shops, who've come here. Long question, simple answer. So what's your view on that?
I mean, I think the Middle East is going to be an increasingly important geography. 7 years ago, there were 3 fintechs in Saudi, and they're now 400.
Yeah, 250.
Just to give you, I mean, depends how you define it.
Yeah.
But I think we see, and I think just to give, I've had the fortune of going out to the region 4 or 5 times in the last few years. We have a couple of investors from the region. We have also invested in a company which has moved out there, and we've invested in 2 other companies which have set up subsidiaries there. And we are seeing a lot of companies, even though they're domiciled in the UK, servicing the GCC. So I think it's not hot air. There's huge amount of opportunity there. What you're seeing, obviously, is as more money and more people move into the world, you're seeing into that space, you're seeing inflation of valuation, which is kind of part of the course. But that, I think, will settle itself as the market matures. And you are seeing some huge success stories now emerging, Tabby and others who've raised huge amounts of money, but not only that, but actually the metrics to back it up. So I'm very bullish on the GCC. The battle between UAE and Saudi is a healthy one. Competition is good. So important. I think that, for Britain specifically, who has historical links to that region, I know they are trying. They need to double down in terms of really attracting both inflow of capital to the UK and companies going over there. I mean, we've been on a few of the trade missions. We see what's going on there. I think we should be doing a lot more in terms of where Outward will be in the next few years. We have, obviously, as the government, as an anchor investor, we hope they continue to support us as we deliver in Fund 3. And I think increasingly a lot of our companies will have exposure to the region, given that we, some of, as I said, have already set up offices there and subsidiaries there. So geographically, we want to stay very much, we believe local is relevant. We want to believe that we can back our founders best when we're around them. Though I think what we are seeing is that the world is becoming smaller and smaller despite the last few months. And therefore, exposure to that region, which is one of the fastest growing, will be very important for us.
No, I agree with you. I've been here 15 years. I've known Tabby from day zero. Hussam and me go back from days when Tabby was actually an idea on a piece of paper. and a number of the startups. I think there are 3-4 things which have happened, which is changed. The copycats have learned how to localize, which they didn't know initially. I think the quality of the founder and the founding team, or if I may say, the core team, has actually become more diversified and better, right? So they're bringing some of the best of breed people for all sorts of reasons. People are moving here, and thirdly, I think we're starting to see people address sort of what I call real needs at scale, right? Rather than yet another crowdfunding platform, right? And I'm nothing against crowdfunding, but we've had that mad rush. What I do want to see more of, and to be honest with you, what we have historically seen is a number of VCs come here primarily from a perspective of raising investors into their own funds, which then helps the investors here diversify their exposure, which is completely understood. But bringing that sort of in, not just their money, because I don't think we lack the cash in this part of the world. I think we do lack the experience and some of the grit and resilience. And we'd love to see that, more of it. And what I'm really looking to see, and we do, I think, one of the countries which doesn't get talked about much, but actually has an incredible list of founders, is Egypt, right? And these guys are solving real problems at scale, mostly using infrastructure, which to me is the sweetest spot, right? And largely because, it's 100 million people and massive financial inclusion challenges. Is actually some founders here going global? Right, I'd love to see some startups out here, right, which are playing in a multi-market manner. And that doesn't mean they need to go to Europe, because I think there's this huge sort of Central Asia piece, right, where there's lots of synergies economically, where I think fintechs can go. There's language, there's tradition, there's culture, which is similarity. So hopefully you can find some investors, companies here that you can then drag them to Europe, because that's kind of what will really, really make this ecosystem super attractive, rather than, as you said, LinkedIn and all the hype that we create out here.
That we see.
Yeah, Devin, thanks a lot. If you're ever in this part of the world, and now we have common friends and so on and so forth, and you're part of the alumni, so part of, I think, the 130, 140 people who've kind of I've been fortunate enough to actually have on the show. So I think you'll meet a lot of other people who you might know in the group. So if you're ever in this part of the world, give us a shout. But with that, I'd like to thank you.
No, pleasure. Thank you for having me.
Right. Cheers. So, ladies and gentlemen, that was Devin Kohli, who is the general partner and founder of Outward VC. Interesting story. We, I think, covered a lot of ground. A lot of it would have definitely resonated with VCs and startups in this part of the world. I'll make sure that next time Devin's in town, especially if you're a startup founder hearing in, we'll try and get you guys on his radar. We might even get him across to our sort of big fintech events, which we have every month. But with that, I'll say goodbye till next week. Bye-bye.